Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Since I was born, been stacking my coins. These niggas is pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fuck like porn. These rappers is whack, they lyrics is corn. I'm getting this money, it never get born. I'm loading my strap, they calling the law. Fuck around and get clapped for running your jaw. If it ain't about the dollars, then it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like a crypto crash. Stacking my coin, stacking my coin, stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin, stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash.
Smoking on that crippy got me cliff high. Steam pot, heat rock, slingshot. Surfing through the city while them chips rise. Hot boy, do it big time. Element with my summer bay, we booed up. Cali hit the bay, we fly MIA, we pulled up. Sipping on this drink, bitch, I know the way. We juiced up, nigga violate till it's JFK like Jerufa. Coin daddy bout them chips, nigga rap snacks. Face all in a box, nigga Snapchat. Fucking with the ops to get you clapped back. No cap, nigga rap.
Stacking my coin, stacking my coin, stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash.
Keep my wife's name out your fucking mouth!
Bitcoin, Litecoin, Ethereum, cash. Yeah. Yeah. Stacking my coin, stacking my coin, stacking my coin, stacking my coin.
This episode is brought to you by FairDesk, a crypto derivatives trading platform founded by 6 former Binance execs and 3 former Morgan Stanley architects. FairDesk is a company focused on building a platform that enables traders to profit from both rising and falling markets. Sign up today and CB will credit you up to $600 in trading funds. For more information, visit fairdesk.com, link in the description below.
Yeah, stacking my coin, stacking my coin, stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum.
Fuck it! Do it live! I'll write it and we'll do it live!
Okay. Ready?
Fucking thing sucks! We'll do it live.
Okay.
We doing it live, baby! Let's go. What's going on, ladies and gents? Welcome to another episode of Off the Chain. Not my two Satoshis. Is there a difference? You'll never know. Hope everybody's doing well. We got a lot of people in the building already. 33 in the building. Mr. Minho in the building from across the pond. All my UK bruvs, what's going on? We've got Wisdom Bars in the building. I'll be surprised if we see 100 basis points. I wouldn't, my friend. 50 basis points. Oh my God. If we only do 50 basis points, you're going to see Bitcoin go up like 9-10% in like an hour and a half or two, which will be cool for me. Well, I'm going to show you why. Because, you know, Bloodalytics, we're in a position right now. So we'll go through all that in a minute. Minho said 50 or 75 might rally. No, 50 would rally. 75 would rally. 50 would tear. Just, it would be insane. It would be insane. What's up, 64 ECG? Thanks for tuning in. Joshua McCain in the building. Red River in the building. He said he would join us if we went live at 1:30. And I'm doing it live at 1:30. Red River doing it. He said feels like Christmas. Why is that? Tell me. What up, Tommy Brown? Philly in the building with my young bulls. We got who else we got here? Will dump 100 will dump. Absolutely. 100 will definitely dump us. So we don't, I mean, it depends on which direction you are in the markets. You may be ready for that. Hidden Profits Crypto in the building. So, hey, this is a different format today on Off the Chain. First of all, I usually don't do off the chains, but on weekends. But because we have the FOMC meeting, I wanted to definitely have an off the chain episode. This is an Ask Me Anything as well. We'll have that open dialogue today. Pop some shots for your boy. We got 10 Pound in the building. 10 Pound in the building. That's my guy. So, you know, we're going to open it up for questions. Ask me anything. We're going to go over Bloodalytics live and direct. I got a couple articles for us today. But hey, we're just going to keep it real smooth and easy today, ladies and gentlemen. CB had Red Bull people. No, CB had, you know what? You're kind of right. I'm going crazy right now because this chai tea full of caffeine. I might do a 2-hour live stream today. Who knows? 10 number alive in the, I don't know what you're talking about, 10 Pound. Get it together. Bubba Smith said, wanting for 100 dump. Powell needs to wake up. You're right. He does. As always, the Fed looks in the rear view. They drive through the rear view mirror. They're always looking at data in the past to make decisions for today. And it always ends in disaster. So he needs to do 150. He needs to do 200. Like the number on my dashboard. He needs to do 200. That's what he needs to do to really get it going. My view on what, Sarvesh? Please help me understand. BTC pumping. Haven't even looked at the charts. We'll get to that in a second. 2 hours. Do it. Hit them like booties, people. Yes. Thank you again, Mr. Sakila, for reminding everyone what to do. If you're new to the channel, you need to understand what you need to do, and that is smack those like booties right now off the stage. Knock her right off the stage. Whip that leg around. Knock her right off the stage, people. Please hit that like button. No, no jokes. Let's please get those likes up. But yeah, I'm loving all the comments here. 200, the economy would crash. You're right. That's how retardedly over leveraged we are. Definitely pride pumping so they can rug pull. Exactly. That's what the markets do. They go one direction, pump fake everybody, get you all loaded in there, and then go the opposite. Definitely. That's what the markets typically like to do. So, yeah, thank you for joining again. I appreciate it. Let me get the chat room on the screen for all the viewers that might just be looking at the screen and not at the chat. At least you can see some of these crazy ass comments that come in this room. Let me tell you. Let me just bring this down just a tad bit like that and bring my socials down a little bit. Oh, what? There we go. There we go. So today I do have a couple of articles, but I want to kind of touch on the markets out the gate because we're seeing a move, as you guys just stated, a move up in the markets happening right now. I'm gonna zoom in because earlier today we had a test of the channel again, and we had this bar right here, this candle right here, ladies and gents. For those who read candle bars, I don't, because it doesn't matter to me. I'm an algo trader, so I just go off price action. But if you take the time to read the tea leaves, the braille, that's a very bearish candle. However, what we're seeing right now is an extremely bullish candle because it's pretty much engulfed this whole bearish candle. So who knows which direction we're going to go ultimately, but it is definitely a bullish tone right now in the market. Shout out to all my Bloodalytics members. You guys are getting it in. I heard one guy today said, "Hey CB, I'm beating your year-to-date performance in just a month." I said, "Okay, hey, okay, buddy. Sounds like you're over trading it. Sounds like you're putting too much on your trades, but hey, you live by the leverage, you die by the leverage. You do what you got to do, homie." But people are making good money in the trading room. Bloodalytics.com. If you want to know more information and how to sign up for that, I will have a special discount at the end of the stream, so stay tuned for that. Crypto writers in the building. What's going on, bro? Thank you for tuning in. Mr. Sakila said Russia getting ready for war. Markets will tank. Yeah, I saw that on Zero Hedge earlier today. D-Born in the building. What's popping with you, man? Thank you for tuning in. Again, listen, I got us live streaming. Where is it at? Got us live streaming CNBC right now. Okay, so we'll tune in once we start getting some news on the minutes. At 2:30, the Fed Jerome Powell Fed chair will talk. Okay, at 2:30. So I'll be on through that as well. So it's going to be a decent length live stream. So tune in all the way. You don't want to miss this stuff. I think we go up significantly. Bearish sentiment is extreme. I agree. Anything. So when you're oversold this much and everybody is bearish, everybody is crypto blood now from when I was calling tops at $65,000 Bitcoin. Well, maybe not that high. It was like $45,000 Bitcoin. Everybody is where I was then. So you might be right, Seba. You absolutely might be right. This looks like a 50 basis point hike gamble pump just in case Jerome is willing to go past the point of no return. 75 pump and 100 basis point will dump. Is that the thought or prediction? Yes. Yes, 75 should give us a slight pump. 50 is just rip your face off rally in all markets. 100 basis point, which I'm leaning to. Crypto Domus is leaning towards 100 basis points. So I think it's going to be a crash, but my feelings are not important because, ladies and gentlemen, we don't trade by the feelings. Okay, we trade by the rules, by the parameters. That's all we trade on. We don't care what our feelings are. Okay, as you guys can see right now, we've been killing it the last few days in Bloodalytics. Went short yesterday, took half our profits there, took another nibble off right there, and then closed the rest of that trade at that point in the markets there, and went long earlier today at around 6:50 a.m. Eastern Standard Time. So we're double long Ethereum, Bitcoin right now, Ethereum USD, and Bitcoin versus USD. We're double long. As you guys can see, that is the situation for us right now with the Bloodalytics crew. So, I mean, we're happy. even though I think it's going to be a dump, and it still may be a dump, you know, we're going to act accordingly. We're going to switch our position if that is the case, and you know, get the hell out of Dodge. That's just what it is, ladies and gentlemen. No feelings attached. Okay? No feelings attached at all with these trading markets, with these streets. Leave your feelings in the bed before you got up. Leave them there, because we don't need them. Let me see what some of these other comments say here. Going to be one basis point. Oh my God! Any pump will not last past a day or two. Agreed. We saw this. Let me see if I can even pull it up on the chat, or in the chart, I should say. So way back, I don't have you guys on the screen, so let me get you on the screen. 151 in the building. Thanks for tuning in. Red River said, fun fact, rates have only been raised 100 basis points 7 times since World War II. Well, hey, that means nothing, bro. It can most definitely happen. 151 in the building. Thanks for tuning in, brother. So let me darn it, I keep doing this. Let me put my cross tool on, and let's slide back down memory lane past 17.5. Mr. Young Jeezy, not sure if we're gonna visit you just yet, homie. Let's move back some more, and voila. Remember this right here. This was on December 15th last year. Fed came out, FOMC meeting. Fed came out, boom, pumped hard, and then reversed the whole damn thing and came all the way back down. But we had some support at $45,000 Bitcoin. Oh, remember those days? And we ultimately, over the span of a few days, moved back up again. So you just never know, man. You never know. That's why you need to have an edge with some type of signal that's going to give you some competitive edge in the markets, and not rely on your feelings, because you guys' feelings are weak. Let's see here. 10 Pound said, war is financed by funny money. Absolutely. Zudini in the building. Shout out to you, bro. Thank you for tuning in. Oh, you mean 100 basis points? Yeah, I'm leaning toward 100 basis points as well, Mr. Sakila. We will see. Quick question: do you think the dot plot, I think that's what he's talking about, will be raised? I do. Yes, we're going to take a look at the terminal rate for interest rate. That has jumped up a little bit. Okay, it's at 4.5 and some change now. 450 basis points. It's been notched up a little bit. Matter of fact, let's go ahead and take a look at that right now, since you brought it up, Red River. Let me see. Scroll this over. So as you guys can see here, the terminal rate in this zero hedge article, I'm sorry, has jumped a bit. Okay, terminal rate for the Fed rate hike has risen to 4.52. So 452 basis points this morning, expected in March of 2023. So tell me, not even long term, short term, the next 6 to 8 months, the next 6 months, tell me, how do we have a thriving stock market, a thriving or bullish crypto market, a thriving housing market, with terminal rates looking to be at 4.5 or 450 basis points by March? Now, you got to understand where we are right now. I think we're at 300 and something basis points. So I just don't see this being favorable for risk on assets. And I think it is going to be favorable for bonds. And we'll look at that here in a little while as well. So to your point, I mean, the dot plot probably will move up a little bit. this was a tweet from earlier that Zero Hedge put out, as you guys can see. And make sure, just real quick, we got 70 people in the building. This is a decent amount for a live stream, the middle of the day, Wednesday. Listen, smack those like booties right now for me. Make sure if we got 70 people watching, I should goddamn for sure have 70 thumbs up. Okay, thank you. Have a great day. So I think dot plot will be increased or raised up a little bit for the future, and that's just not good news for the stock market, for cryptos. You guys know that. So as you guys can see, I'm just pulling this up. This is an OG site I've used for almost 15 years. Okay, forexfactory.com. This is the site I use for economic data, calendars, or whatnot to see what's going on. We've got the FOMC projections coming out at 2 o'clock, and including that, the FOMC statement and federal funds rate. So that's what we're looking at. Again, previous was 250. So if we do a 75 basis point, this is the forecast. People are looking at 3 1/4. Now, again, I just don't think it's going to be 75. I think it's going to be a whole 100. So we'll be at 3.5%. We'll see. We'll see. But that is what the calendar looks like. 2 o'clock. All three of these are coming out. 2:30 FOMC press conference. We've got about 3 minutes left. And what I'll do is when that 2 o'clock marker hits, or right before it, we'll go over to CNBC and see what the talking heads have to say. So that is kind of where we are. That's the state of cryptos. We're pumping right now. As you guys can see from the heat map, 360.com, coin360.com, the heat map is showing us a big pump. So let's go ahead. I'm going to fade to black for a little bit, and we're just going to watch the stream from CNBC for a minute and see what the news is looking like for us. All right, so let me get that queued up, and I'll be back here in a second. You guys leave any comments, any questions you may have in the chat room right now. Click that thumbs up. Let me see how many people we got with the thumbs up count. I just need to know real quick because I don't want to get mad. We have currently, come on, 51 likes. Let's get that up a tad bit more, ladies and gentlemen. Let's get that up a tad bit more. So, again, I'll be back here in probably about 2 or 3 minutes. Actually, about 4 minutes. No, let's just say 5 minutes. Holla.
Work to do, and are very likely to sound hawkish and probably signal another 75 basis point move again at the next meeting.
Katie, the rapid rise in the 2-year note, now above 4%, what does that tell you about how investors are positioned ahead of the decision?
Seema, investors are expecting 75 basis points, and I think investors are expecting the kind of scenario that's been outlined by the prior two guests. The Fed's going to hike further than we had thought, and going to stay there for a little bit longer than we thought as well. So I think investors are positioning for that. But what you see in the yield curve is interesting, which is investors are also coming around to the fact that this is going to slow down the economy. So you've got this inversion, you've got this problem in the yield curve that's reflecting a lot of uncertainty about the economic outlook. So we're going to have to deal with that next year.
Jim, I'm going to come back to you because David is worried that the Fed may go too far and stay there too long and really damage.
Look at that rally, ladies and gentlemen.
You seem to have a more nuanced view of that. I've got 45 seconds. Explain why you are less
Look
worried
at that rally. Wow.
Seemingly
Big wick.
David is. Quickly.
Pause.
Well, I think that we're likely to have a mild recession. There's no question about that.
Wow.
The idea, though, is that the labor market is as strong as it is. It's very hard to have a protracted recession when the labor market is so strong. So
no.
If the Fed won't hike rates too far and keep them there for too long, they probably will. It's just a question of how much of an impact does that have on the
we got stopped out our short, our long on Ethereum.
Most likely does that cause, and how
we're still
that recession
okay. There we go.
And I'm in the camp that it might be a little bit more on the mild side.
It's a lot of whips.
Right. Well,
a lot of action going on, ladies and gents.
Time, both in terms of the economy, in terms of geopolitics, and the rest.
Let's see what happens.
10 seconds now until we can go to Steve Leisman for the news, and let's do that right now.
The Federal Reserve raising interest rates by 0.75 of a percentage point to a new range of 3 and 3.25%.
Okay, we got 3 and 3.25.
And 8. The Fed saying that ongoing increases will likely be appropriate in the funds rate. The Fed also saying inflation remains elevated. It sharply raised the median forecast of a Federal Reserve official, sharply raising the outlook for the funds rate for this year to 4.4%. From 3.4%, so a full percentage point. By the way, that is a little higher than the market was going into this meeting here. For 2023, the median forecast is for a 4.6% funds rate. Again, a bit higher on the peak rate than where the market was, and that was from 3.8. For 2024, the median forecast is 3.9 from 3.4. 10 members do see a number below that 3.9 level. So if you want to think about the Federal Reserve cutting rates, that looks like it's going to happen sometime in 2024, getting back down to the new number we have for 2025, and that is 3.9%. A sharply lower GDP outlook, just 0.2% forecast for this year, down from 1.7, 1.2% for 2023, down from 1.7, and then gradually the Fed sees the economy, economic growth getting back towards the trend of 1.8%. A big but not tremendous increase in the unemployment rate outlook, 4.4 for 2023 from 3.9, so almost a percentage point or more higher than the low rate of 3.5, about a percentage point. Inflation nears the target of 2.3, not until 2024, hits the target of 2% in 2025. Going back to the statement, very much a cookie-cutter statement from the July wording, saying that modest growth in spending and production, it had said it was softening, now it sees modest growth, continues to see robust job gains and elevated inflation from supply-demand imbalances, higher food and energy, and broader price pressures as well. The committee remains on track for that $95 billion reduction in the balance sheet, and the decision was unanimous, with, I believe, the first time we've had 19 members of the Federal Reserve with a full Federal Reserve governor for maybe as almost a decade. Tyler, back to you.
Steve, thank you. Let's bring in the panel now. Bob Pisani from the New York Stock Exchange, Rick Santelli also joining us. And Rick, let's start with you and the move we're seeing in the bond market and stocks, which are reversing early gains. The S&P 500 now trading in negative territory, a 75 basis point rate hike.
Yes, you know, I'm watching all the different maturities on the yield curve, and one thing I can tell you is right before the Fed announcement, rates were virtually unchanged. We're now up 13, 14 basis points on the session on a 2-year. The high yield on a 2-year.
Good one, bro. I wanted 100 too.
4.11, 4.11. Like when
these guys are pussyfooting around, man. They're gonna be way behind. They're gonna be way behind, ladies and gentlemen.
Fed fund futures, and there's so many contracts. I'm looking at the January. It dropped like a rock down towards 95.66. When its prices go down, the Fed presence goes up, but it's bouncing a little bit, and you are seeing yields very volatile, and I described the way they move, but they are easing back just
Look
a
at
bit.
the 2-year.
Waiting for Q&A.
Huge drop.
Ultimately, another dynamic was prevalent right before the announcement. 30-year and 10-year yields were on top of each other. It actually inverted briefly. That's a very unusual inversion, because 30s to 10s, known as the knob spread, since 2006 has only had 2 sessions, and they were both this year, where they closed inverted. You want to pay attention there. And last but certainly not least, the dollar index, certainly the beneficiary of the path the Fed has taken.
All right, Rick Santelli, thank you very much. Let's check in now with Bob Pisani. We had basically there a 200-point swing from where the Dow was, I'm talking about, Bob, right on the precipice of the announcement to where we are now, which is down 168. We were up about 160. Now we're down 160. That's, what, 320 points, actually.
Yeah, and I watched the S&P. We were at 3880 or so, and we've dropped about 40 points or so since then. And it's very obviously why. This is what the market didn't want, the higher for longer scenario here. So we have a higher Fed funds projected rate for 2022. We have a higher Fed funds.
That's what the markets didn't like, ladies and gentlemen.
No reductions until 2024. Not quite priced into the market. So very understandably why the market has moved down here. So we know why Powell Powell's been so aggressive here. The stock market's rallied, the labor market's strong, and inflation stayed higher longer. And even if it is peaking, it's still higher for longer. So the two issues I polled traders this morning, and the two issues I got was, number one, they want to know how high the Fed fund rate is going to be, the terminal rate. Obviously, it's now higher than people had thought earlier. And when there's concerns about over,
I just talked about terminal rate too.
That's what they want to hear at the presser. So I think the problem for the presser now is Powell is going to maintain maximum flexibility. He's going to not give any hints about the next rate
Very
hike.
true, wisdom
Obviously,
bars. That would have been devastating, but that's what we need.
75 basis points.
Unfortunately,
and he's certainly going to push back against any pivot next year. For the market here, remember, we're about 5% above where we were at the market lows on June 16th. That's 36.66 or so. And is there anything at the press conference that might sound a little less hawkish? I think if he would acknowledge somehow.
Exactly, Hank. That's exactly what we need to do.
Kind of effects from the
this is nonsense.
They already have some indication that they're aware, at least, of the slowdown. And remember, Powell is winning on a lot of fronts here. Housing is definitely softening. We saw that this morning with the data.
Look at the VIX up 11% off that move.
Picture. Anything, I think, bottom line here is for the presser, anything that indicates they are still data dependent and they'll see what the impact the rate hikes have, that might ameliorate some of this. But this initial projections for Fed funds future for 2022 and 2023, that's the negative for the market.
Let's open up the discussion with our panelists. And David, I want to go with you. The Fed reiterating that inflation remains elevated, but again, sharply raising their projections for the Fed funds rate for this.
So there you have it. As you know, we talked about prior to the news, we would probably see a move up and then and then it goes the other way. It happens so often, not every time, but happens very often, often enough to be something you would be looking to see, right? You wouldn't be shocked if that happened. So that's exactly what happened with the markets. As you guys see here, I'm going to bring up the My 2 Satoshi chart. And wow, this is humongous. This is very bearish. Full, almost full and bearish engulf candle, taking out what that hike was that we saw the pump all the way into almost to the middle of the channel and got slammed down, engulfing everything here. This whole move that we saw over the last day or so, fully engulfed. So we just got to see how this pans out. But me personally, I think this is going to be a signal to head lower. So what does that mean for Bloodalytics? Well, again, we went long earlier today. Thank God we did take 50% of our profits off on Ethereum's trade right before the news. We took 50% off. Man, that Bloodalytics, boy. So we end up getting stopped out the rest of it, but at least we mitigated our losses a little bit with that 50% take profit and got stopped out on Ethereum. And look at this wick on Bitcoin. Wow, that is a serious wick right there. And yeah, this is we're gonna be moving downward, I think, at this point. Just waiting for the confirmation from Bloodalytics to go short on both Ethereum and Bitcoin. I'll tune in and let you guys see the charts later in this hour, and we'll see what happens here. But I think we should probably be going, unless the bulls bid this back up, which is very possible. We got 2 minutes left on this closing bar for Bloodalytics to see what's going on and to see what happens in which direction we end up going. At this point, though, we are out of both positions. So we're neutral in the markets right now, waiting for the next trade. So that is where we are at the moment. If I let's go over to some other news. I'm gonna get to some comments though real quick and see what you guys are talking about here. So we've got Bubba Smith said 15 to 17K stop on the way to 10K, but it's coming. Can't wait for low. Buy more. You can buy more. My wife won't let me buy more H-Bar. Guess I got to dip into my stash account. That's hilarious. H-Bar is a good project. I like it. Jace Max says 17.5 by end of day. Oh, no. So we're going back to see Mr. Jeezy himself? Are you serious? You think we're going to 17.5 by the end of the day? Where's Mr. Jeezy at? We're going to Mr. 17.5 by the end of the day. Now let's just do a quick measure on that. Honestly, that's 7% from here. Not impossible. Not impossible. So I can see that occurring. Jace Mack. I believe the initial move, even if we get a Fed a Powell bounce later, I believe the initial move. So you mean you believe we're heading lower? Yeah, that mom, that move, that's what happens on these volatile FOMC meetings. Red River said all GDP projections have been lowered as well. Yes, I did notice that. I don't know what DOD means. 10 pound, help me out. Market will go sideways, bro. No. But we'll have to see. Let's see what the talking heads are saying really quickly.
What I think is also, as the last guest suggested, a little bit difficult to understand or to equate is this somewhat still modest rise in the unemployment rate. Mm-hmm. The idea that the only pain you're going to get, where were we down at 3.5 was the low, yep, and you're going to go to 4.4, you're going to get less than a percentage point increase in the unemployment rate while you have this huge increase in the funds rate that attempts to slow the economy. I think that's lacking a little credibility here. I will just say this final point here. This forecast is almost certainly going to be wrong, and the challenge for investors at this point is to figure out how.
And that's what investors are trying to figure out. I just want to draw our attention to the 2-year note, which is sensitive to monetary policy. Rick Santelli now above 4.4% at 4.1.
Look, Bond.
Yeah, I think that pretty much I agree with David on most issues. I think the 2-year note yields are blinding to many investors. They shouldn't be blinded by that. They should move down the curve. You're getting a much better picture of reality in 10s and 30s, which, by the way, have inverted. You're now at 359 in 10s, 355 in 30s. Ultimately, this is the tough love chapter of a central bank that didn't do a very good job of trying to tone down some of the COVID stimulus in enough time not to seed inflation. They were probably blindsided by the war in Ukraine. And here we are. But the tough love phase, it's going to disappear at some point because there is a period out there, as David Kelly has pointed out, where we're going to see everything cross. Their inflation dots are going to keep going up, and the market on inflation is going to go down. And that reality, investors can almost smell it. It's just a question of when it occurs. Is it going to occur in mid-23 or is it going to occur in late 23?
Let's talk about the dollar, Rick. You heard Jim Karen just say that this strong dollar, now at a 20-year high for the dollar against the basket of currencies, is going to crush our exporters. Talk to me about that.
If we were China, if we were Japan, if we were Germany, I'd worry about it a whole lot more. We don't have an export economy. We have a consumption economy. And consumption will improve with a strong dollar because imports and a variety of imports are going to be much cheaper. Mm-hmm. Yes. So, listen, we can all fret about the damage it's doing overseas, but I would be fretting to the central bankers who really caused this mess because they caused us to be in a place where the solution had to be this painful.
David, a stronger dollar, higher rates. How does this change the calculus for stocks? We've certainly seen earnings estimates come down in recent weeks.
Well, yes, it's going to be a tough year ahead for earnings, no doubt about it. But in a way, that, one of the reasons I don't like the Fed being too aggressive right now is that I want them to actually be able to get to positive real rates and stay there. What I think they're setting up is a situation where they actually put the economy in recession, and then, much as they would deny it today, they are eventually going to reverse course. And when they do, we're going to end up back in a slow growth, low inflation, and ultimately low interest rate environment, which I think will be good for equity markets in the long run. It's going to be a bumpy ride until we get there. But for long-term investors, I actually think there is an opportunity here because eventually the Fed's going to have to turn course here because they're just doing too much today.
But that's going to play out over time. It's going to take a while.
Well, stocks are a long-term investment.
Katie, I'll give you a last, final, ultra final word.
Well, Tyler, it's real hawkish report here for sure on the part of the Fed, and I think investors, equity investors, hearkening to something Rick said. You know, the economy is not as exposed to exports, but the S&P 500 certainly is. So I think investors are going to pivot from worrying about the valuation impact of higher rates to now the earnings impact of these higher rates, not just through the currency channel, but through the slower economic growth channel as well. So we have another sort of transitional set of worries to think about as we get into 2023.
I'm dying to ask Steve what he's going to ask the chairman, but I'm going to let that be our big surprise. Panelists, thank you very much. We appreciate your time today. As always, all of you, thank you for joining us. Coming up, former Fed Governor Frederick Mishkin will tell us whether he thinks the central bank is on the right track. Finally, we're making a policy.
All right, guys, there you have it. Commentary for the day. Yeah, that thing went parabolic, man. It is on and popping. I love the volatility. We're waiting for the next trade here. Bubba Smith, thanks for the stream. Thanks, man. Appreciate you tuning in for a minute. Really do appreciate all of you guys' time and attention. So real quick, I saw a comment from earlier. I pinned it, and I wanted to address it because it's crazy, man, how the universe works. I literally was looking for this guy again, trying to find out if I can get some information and contact him. Let me answer this question. When is the halving event of the Good one, bro. Very good one. Very good one. Morphine in the building. What's going on, bro? Let me look a shot for Morphine real quick. Yeah, the halving event for the dollar is never, bro. I'm gonna be honest with you. I don't see the dollar going anywhere. Actually, ironically enough, there's been maybe a few more times in history where there's been more demand for the dollar. Only a few other times in history. There is a lot of demand for dollar. See, we always think of the dollar in terms of inside of America, right? We're always saying, oh, man, they're printing too much money. Yes, they are printing too much money within the United States, but those dollars spill out into and all over the globe. So you got to think of the printing of dollars in context of how many people around the globe, of 7-something billion people, how many people are in demand for dollars. And understand, the dollar is the most fiat currency in demand. People need dollars to pay back debts. People take out and when I say people, nations, businesses across the globe, they use the dollar. So that's why the dollar is in such demand, and you won't see a deflationary event for a very long time, or if never. Like my guy 10 Pound just said, deflationary for the dollar is never coming. It's possible. I won't say never, can't ever say never, but definitely I don't see it happening no time soon. Hank Orwitz says the dollar seems to operate on doubling events. Explain that a little bit more. D-Born said, do you see any value in precious metals? Not really, other than it's just another form or way to protect yourself against a potential deflationary event. Do precious metals do well in an inflationary environment? Not compared to Bitcoin if you stretch it out, right? So, I mean, I think just for the sake of, diversifying, you should have some precious metals for sure. Is it going to be like the knight armor that saves the whole? No. Because it's not. If we go really, really strong inflationary environment, I won't say hyperinflation. I don't think that's going to happen in the United States with the reserve world currency. But if we have a very strong inflationary environment, then Bitcoin cryptos are going to grossly outperform precious metals yet again. It's going to happen again. And if we have a deflationary event, listen, it's going to be, the best. In that case, I think it will be one of the better assets to have, meaning you'll lose the least amount of money being in gold, silver in a deflationary environment where everything is crashing. So yeah, you're going to get wrecked in a deflationary environment with Bitcoin, with cryptos. You're going to get absolutely slaughtered. Maybe the worst performing class out of all asset class out of all of them in a deflationary environment. So keep, it's a double-edged sword. Crypto is the best performing asset class in an inflationary money printing environment, high liquidity environment. But when liquidity shrinks and it's sucked out, it's probably going to be the worst performing asset class. So that's my 2 Satoshis on that. Thank you for the question. What is codify? What is that? Help me out there, Mr. B. My good gold and silver mining stocks are down. Yeah. I think the dollar will come down once Japan raises rates, but who knows when that will happen. Spread your risk. Absolutely, guys. Absolutely. Again, hit that thumbs up, guys, for me. Hit that smash. Spank that like booty. All right. So speaking of liquidity, I do want to quickly talk about, I think there was some area in here about liquidity. So let me get back to the Zero Hedge article because I highlighted some things. He said here, Zero Hedge said, do we really think the Fed can get there without folding to political pressure or flip-flopping to abate risk asset carnage? And he's referring to the implied market Fed terminal rate of 4.5, which I think we just saw was increased. Okay. So do we really think they're going to get there without any political pushback? No, I don't think they're going to ever get there. I really don't. But by the time they try to attempt to get there, it's so much damage done. If they reverse it, it's going to cause more damage. That's why I say it's different this time. People, we always hear, well, it's different this time. It is different this time because if they continue to raise rates, it's going to hurt the markets. It's going to hurt asset classes. It's going to cause a deeper recession, if not depression. And if they stop, well, guess what? The opposite is going to happen. Inflation is going to rally yet again. It's going to shoot immediately when the Feds, the day they come out and say, we're pausing, and they don't even have to reverse. If they say they're stopping, it's on and popping again. Inflation going out of control, going higher and higher and higher. So it's damned if they do, damned if they don't. That's a scenario they put themselves in from trying to basically look out for the rich for the last 15 years. This is what they get. This is the corner they've painted themselves into. So he said, what else? There was something else I wanted to show you guys in here. I don't know if I can't find it right now, but yeah, that's where we are with the Feds, man. It's damned if they do, damned if they don't. Red River said, I love precious metals, but for artwork and jewelry. I hear you. Gaddafi. Oh, Gaddafi, the man they tried to go against the dollar, ends up dead. Gaddafi. Yeah, no doubt. The only bullish narrative I can see right now is that it will only take one of the 19 members, FOMC, to change their mind, and we will get a 50 basis point hike next hike. Data will continue to be important. Yeah, we'll see, man. Let's check on the Bloodalytics real quick and see what's going on here. So looks like we're about to go short on Bitcoin. I'm giving you guys a free trade here, and we're about to go long on Ethereum, which is cool. That gives us an opportunity to kind of hedge our bets here, and one of them should win, hopefully. There's been scenarios in the past of trading over these years. You get tapped out both ways, but I think that this is a good position for us to be in at this point that we are. I'm sorry, I wasn't even showing the screen there. We're going long on Ethereum. We're going short on Bitcoin. Let the battle begin, and we'll see what happens from here. Here's your free trade for the day with Bloodalytics. All right, so it is what it is there, guys. Stay tuned to the end. I will be giving a discount for the Bloodalytics system as well. So stay tuned to the end for that. But yeah, I mean, it's an interesting situation we're in right now. I think it can go either way as far as what the Fed decides to do here. I just feel like either way, it's not a good look for them. Either way, it's not a good look for them. So we shall see, ladies and gents. We shall see. Let's go ahead and kick off some crypto news for a minute. D. Bourne said, great show. Have a good one. Thanks, D. Bourne, for tuning in. We're going to go up until probably after 2:30, because 2:30 Jerome Powell comes out and speaks. We'll fade to black again and let Powell talk and see what's happening. So real quick, this is some EOS news, which is a very pivotal, instrumental, whatever word you want to say, day for EOS with this upgrade. So they've upgraded, they've made a blockchain upgrade with the consensus upgrade to Antelope Leap 3.1. So this is essentially, and I'm just going to read it. Today, the EOS community declares independence, stepping into its own destiny. From the verge of disillusion, we have emerged stronger and more united than ever. Where we go from here is up to us. So my good boy Yves LaRose said here, today is the hard-won culmination of our efforts to secure independence for the EOS blockchain. Thanks to the EOS block producers, through their trust, support, and their technical prowess, the ENF has been able to proceed unhindered in our mission to deliver value to the EOS network. A special thanks to Zach Gall for having the vision and the courage to step up and to be a part of this journey with me from day one. Thanks to the many dedicated developers and project leaders who rallied together and coordinated this massive feat of engineering. Our code is now on solid footing thanks to a diverse and resilient community. The momentum we have been steadily building is now a force to be reckoned with. This is a great victory, but we can't bask in our own glory for long. We have to keep moving. What becomes of EOS next is what we make of it. All right, so yeah, this is big news for EOS. You know, they've been hindered big time, in my opinion, by Block One, really doing them dirty, doing the community dirty, and they've upgraded, and pretty much this upgrade, consensus upgrade, allows them to break free from the EOS, or I should say Block One repositories, if you want to say. And so that's where we are with things. This article goes on to say, today we are liberating the code that embodies our collective aspirations for a resilient public blockchain network. We liberate the code not for a privileged few, but for an open future built on open source foundations. So this is we'll see what happens. Right now EOS is down. It was down when I saw it this morning. It's probably down even more, so down 3% right now. So is the markets. Well, it's kind of wishy-washy, but yeah, we'll see how that pans out for EOS. So it's 2:30 now. I'm going to fade to black, and we're going to get and see what Jerome Powell is talking about here. Let's get it cracking, ladies and gents.
I think
done, at least for the median stock out there, for a lot of sectors that have actually adjusted. We've had a valuation reset. It's all about whether the economy can actually stay. Look, nominal GDP growth they're projecting is about 4% for the next few years. That's not awful. And so we'll see how corporate earnings can fare in an environment if that's something like what we get out there. I think you're still talking about the Fed doesn't want the markets to get too comfortable, and right now it's succeeding.
Yeah, it is definitely succeeding in not letting the markets get too comfortable. Mike, thank you very much. I want to ask you to stick around for just a second as we watch the clock here counting down to 2:30. He's usually pretty close to time. Take a note of where the Dow Industrials stand right now, down 188 points, just for reference's sake, as you watch sort of the EKG of the market over the next 45 minutes or an hour. And here comes Chair Powell.
Come on, Jerome. Come on, man.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
Oh, come on.
We have both
Nonsense.
the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Enter the fake staged questions,
Hi, Chair
ladies
Powell.
and
Thank
gentlemen.
you for taking our questions. Gina Smiley from
The soft
New York Times.
questions.
I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly
Right,
resolved
10
to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve
all
a period of growth
scripted,
below trend,
Knez,
and
all
also some
scripted.
softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC.
Now this guy I can't stand. Steve Leisman. I cannot stand him. He is a brown noser.
Inflation and the extent to which the outlook for rates should be seen
Since
as
you like the Fed so much, Leisman, go work for him.
Rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that.
Oh, wow.
And that's why I noted in my
This must have just been
just
crossed the headline.
As the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
Answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Hey, Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible,
Get out of here.
I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that
impossible, bro. Like
stability would mean
you never get it back to 2%.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to
very true,
people.
Mr. Sekila.
That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick. Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about it in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about this sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be.
This market is climbing up out of that, man. This is crazy volatility, ladies and gentlemen. This is insane.
And we did today.
We're still long our Ethereum. As we trade down here at 13.16.
We need to get to, and we're still discovering.
Got tapped out our short.
People are writing that
on
down
Bitcoin
in their SEP.
We're looking to potentially, depends on where this bar closes. We're thinking about going short again on Bitcoin up here.
Chair Powell, how should we
but it's close to us going long here on Bitcoin. So we just have to pay attention. Next bar will kind of determine that.
And yet the dot plot projects cuts as early as 2024. And does that mean there's a level of inflation
it was great the signal had us hedged, going long ETH and short Bitcoin. That way we didn't get double slaughtered there.
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed, Treasury rates moved up, so we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our
for the people that we serve. Who do you serve, pal?
We see that
it ain't us.
In the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, Nikki.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people.
Come on, man. Get this conference over.
Given
We're getting
where you are and where you're going
put
with
to sleep
interest rates,
here.
favor a recession. 4.4% unemployment is about 1.3 million jobs.
Man, these
That's
markets
acceptable job loss. And then given
they've
that
swung.
the data you look at
the delta on these swings.
lags in your policy
Crazy.
forward-looking
Even the
and you
stock
don't know what
market.
they are. How will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that
You
there's
don't
a
know what
very
the
high
odds are?
that will have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth.
Look at this swing in the Dow.
1.2, also well below.
Crazy.
So that's a slower. That's a very slow level of growth, and it could give
Algos,
rise to increases in
man.
unemployment.
Plunge protection team,
But
right?
I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, and if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will, will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle.
We just went
on
short again
gas,
on
food,
Bitcoin,
transportation,
so we're
clothing, basics of life.
Bears
and prices go
still
up,
battling
the way
here.
they're going up. You're
So
in trouble
we'll see.
right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence from Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually
fell asleep.
Now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business.
existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market.
That's
all
how
over the country.
Any of you all ever had that uncle
selling to
that smoke squares? You know, I got that square right there. Just dangling right there.
There was a big imbalance between supply and demand. The housing prices were going up unsustainably.
Oh, come on, Jerome. Get it over with, brother. Get it over with.
Bring sort of prices more closely in line with rents and other housing market fundamentals.
That's exactly what's happening. I'm hearing absolutely nothing, bro.
Term,
absolutely nothing.
Supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford
Don't doubt the Bloodalytics crypto, yo.
Through a correction.
Not too soon, my friend. You said it was too soon to go short.
With the housing market,
but we went short.
We
get it in, baby. Look at that. We get it in.
Difficult to find lots now close enough.
Too short for too short. The rapper?
Hard time getting zoning.
Oh, okay. If you're talking about the rapper, okay, yeah.
From a sort of business cycle standpoint,
look at that.
This difficult correction.
Perfect timing.
The housing market back into better balance.
Oh, I'm just playing with you, bro.
Thank you. Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly.
You said something the markets didn't like. Clearly.
So
the hell.
It may take some time. So I think hope for the best, plan for the worst. So
oh my God, look at the drop.
Just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Oh my God, keep going.
Hi, Jean,
keep going.
Market News.
Fill those bags up for CB, baby.
Into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you could pick, and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook, and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Fed Chair Jay Powell, after raising interest rates another 0.75%,
thank you. Finally done.
Is to be done to
turn this stuff off. All right, ladies and gents, we're done with that. I'm going to go ahead and close that window out, never to come back for the rest of the day. I don't want to see another CNBC ticker scrolling, talking heads. I don't want to hear anything. All right, so we're done with that, ladies and gents. So I do want to quickly, actually, let me just do a Mac 10, AK-47. All right. So we're done with that, ladies and gents. I do want to bring your attention, though, to a comment that I did pin And this is crazy, man. I swear we live in a simulation, guys. Like, I was literally thinking about this guy 2 days ago. And I don't know if the guy is still on the stream. Probably not. Might be. But my guy, whatever. You guys see the name on the screen. He said, what happened to your boys Truth Blitz and Silvertooth? Now, Silvertooth I've spoken to in the last year and a half. He's a Hexian. He's bought in. He's drinking the Kool-Aid. But he's alive. He's well. I talked to him. Was supposed to go see him in Illinois. Scheduled conflicts. Couldn't get over there. But my guy Truth Blitz, guys, like, I don't know where this guy is. Any one of my, if I got any older, long-term, like OG subscribers, you guys remember Truth Blitz. I cannot get in touch with this guy. He hasn't made a video in 4 years. He kind of fell off the face of the earth right at the kind of the I don't want to say the height. Yeah, I guess you could say the height of the bear market or the low of the bear market. And I haven't seen him, heard from him since. I don't know where this guy is. I'm like hoping that he's alive, but I have not talked to him. And just to let you know, I'm not playing around. Let me see if I can find, because here, we used to have a podcast together. Crazy. I mean, it was dope, man. We had some great people on there. We've interviewed people like SGT Report. He's not no longer on YouTube, I don't think. We've interviewed what's my guy name? Nico from Populous. That's a whole nother situation. We've interviewed Jim Willie together. Jim Willie is my guy. I got to get him back on. We've interviewed who else? Gregory Manarino. I'm not sure where that interview is. Oh, this is not the Block Party channel. I'll have to bring that up so you can see those. But let me just see if I can show you guys. I literally, a few days ago, right here. No, that's not it. No, that's not it. That's not it. Hold on. Let me scroll down. Let me see if I can find the comment. I don't know which video I made the comment on. But a year ago, I sent out, you know, hey, bro, looking to reconnect. Hope all is well. And then I did one literally the other day. I don't know which video it was, though. Let's see if I can go to the home screen and see maybe which one it was, guys. But, yeah, I've been looking for this guy. I'm not sure where he is, man. It's crazy. It is absolutely crazy. So I don't know where my man TB is. Truth Blitz. Not sure, guys, unfortunately. So let's see what the comments are saying here. Let's get this background music back up as well for us a little bit. I hate being in silence on the stream. I know Big Curious Mom knows about Truth Blitz. Trader Jane, another one, reached out to her. Haven't reached out again lately. It's been about a year and some change. I haven't reached out. But Minho said, yes, brother, I remember both of them for real. You did a video show with yourself and Truth Blitz. Yes, we had a show called around, what was it called? The Block Party. Yep, we sure did, bro. And I'm gonna play the intro to our Block Party podcast. It was super dope. Silver Gold Man. Wow. Now that's a throwback. That's a throwback. That is a throwback for you. I asked a few weeks ago, CB was looking. Yeah, man. I think that you prompted me to go look and try to reach out to him as well. Truth Blitz he has kids. Yes, he does. Yes, he does, man. What city is he in? Truth Blitz was at the time in Connecticut. Yeah, he's been gone 4 years. I haven't heard from him. Haven't seen any content, no Twitter, nothing for 4 years, guys. All right, Red River. Thanks for tuning in, brother. Appreciate it. Appreciate it. Crypto Yo, Trader Jane, man. I'm going to reach out to her today. I'm going to text her. I have her number. So I will text her. Minho said the intro was sick. Yeah, let's play the intro real quick for you so you guys can see that sick ass intro we had. Let's see if this one is playing it. Yep, this one plays it. So check this out.
And Truth Blitz. Today we got a very special guest, Road to Ruda himself, Bix Weir.
Yeah.
We're going to be talking with Bix about future of the crypto space, the future of the US dollar. Is crypto going to be the new system when our current dying system finally kicks? You don't want to miss this episode.
Yeah, I'm excited. We're out. Check this intro out. We had a guy rap. We had a guy do the video, the song and everything.
They was just talking about the blockchain. That's when they heard Janet yelling and the cops came. They said, give me all your Bitcoin and lock aim. Then Jamie Dimon showed up and the shots rained. So they hopped in the Lambo and took off fast. Welcome to the Block Party Podcast.
Come on, man. Ahead of our time. You ain't seen an intro that hot ever. Especially in the webbot community. You ain't never seen an intro that hot. Never. Let me lick a shot for that one, man. Never seen an intro. Matter of fact, I'm the DJ, man. I'm DJ Crypto Blood. We're going to run that one back one more time. Let's do it one more time, ladies and gentlemen. Let's do it one more time. One more time. Let's go.
System finally kicks. You don't want to miss this episode.
Yeah.
This the story of crypto blood and truth blitz. That's when the clip high what the truth is. They was just talking about the blockchain. That's when they heard Janet yelling and the cops came. They said, give me all your Bitcoin and lock aim. Then Jamie Dimon showed up and the shots rained. So they hopped in the Lambo and took off fast. Welcome to the Block Party Podcast.
Ladies and gentlemen, make it into an NFT. I am straight. I ain't going to jail. Nah. You ain't going to get me, homie. Not Crypto Blood. I'm going to stay away from that NFT making stuff, man. I did a very small release on the Wax blockchain just to test it out. It was like at the beginning. But nah, I'm not messing with those NFTs, ladies and gents. Not right now. I got to see what's going on. Truth got kidnapped. Hey, don't say that, man. Come on, John Hill default. Come on, man. So the rapper, okay, I will have to go find this guy. His name was Crypto Wrap Up or something like that. The Crypto Weekly Wrap Up, and he disappeared too. Like, I haven't seen him either. He used to do a Crypto Weekly Wrap Up. He would write a rhyme and kind of do the news recap in a song. It was the dopest. I still have some of his songs in my playlist right now, bro. So, J Snip is still making content. He has a new channel. He got banned from YouTube, and he created a new channel. Yeah, that egghead, exactly. But yeah, I just tripped down memory lane. Shout out to 1984. That definitely jogged my memory there, man. I remember that. Okay, guys, so we're like an hour and 40 in. This is typical for an off the chain episode, so it's nothing out of the norm. But I do want to cover a couple of more things before we get out of here. So let's go ahead and do that. The Wintermute hack. I don't know if you guys heard about that. There was a $200 million, pretty much, it was a $160 million hack, but they have now a $200 million outstanding DeFi debt as a result of that $160 million hack. This is crazy, man. You know, I got another article that talks about this could have been as bad or worse than 3AC or even Celsius crashing and bellying up, and I'll explain that in a second. But the crypto market maker Wintermute, the victim of Tuesday's $160 million hack, has over $200 million in outstanding DeFi debt, okay, to several counterparties, according to on-chain data. The latest data or debt involves a $92 million Tether loan issued by TrueFi, okay, which is actually due to mature on the 15th of October, I should say. Another obligation they have is to Maple Finance, okay, which they owe $75 million, and then they owe $22 million to Clearpool, the latest company to get hit by a wave of hacks across the decentralized finance ecosystem on Tuesday. They've become the latest one. So look, the hackers sent $111 million to Curve Finance 3Pool, with some suggesting that this was done to avoid stablecoins being frozen by guess who? Tether and Circle. Yes, I tell you guys all the time, these stablecoins that we use can be frozen by the company, by the institution, Circle, who runs USDC, and by the institution, what is it called? Not Bitfinex. What's the name, guys? Give me the name of Tether's parent company. Drawing a blank here. You guys can help me out. They run and operate Tether USDT. So it is possible for them to freeze these accounts even if you have your keys. So just kind of putting things into context there. Now, this other article from Cointelegraph talks about how this could have been worse than 3AC Voyager and even Celsius, and they kind of go through why. And it's essentially because Wintermute was a market maker, unlike these other hacks, which were like cryptocurrency exchanges. Celsius was a lending platform. Voyager was like a crypto platform. 3AC was a VC, a crypto VC platform or company or entity. When market makers fail, liquidity dries up, and there is nothing worse for tradable assets than spreads going wider. So we'll see the ramifications of this. They say they have enough money. That's what they all say. Okay? That's what they all say. Not Bitfinex. It's not Bitfinex. It's another name. It's another name. I can't remember the name. It's like it rhymes with Bitfinex. iFinex, I think it is, or something like that. But in addition to traditional proprietary trading desks, Wintermute provides market-making services by facilitating transactions on intermediaries using their own resources. These services can be hired by exchanges, brokers, token issuers, or third-party entities, which as foundations and supporting companies. Yeah, they need to invest, or should have been investing more money in some algorithmic security scripts or something, because this is crazy. This is not the first hack by Wintermute or on Wintermute. Okay, so they need to tighten up. They say they have the money. We'll see. So that's just pin that, because that could be something that comes back and rears its ugly head if they actually don't have the money they say they do to cover the hack. Now, this one, iFinex, yes, iFinex, that's it. This one, ladies and gentlemen, really quickly, out of Watcher.guru, USDC is the first stablecoin to be added to Robinhood. Now, why would that happen? You know why? Because they are setting up, they being the cabal, the Illuminati, the Trilateral Commission, the Bilderberg. Okay, I'm sounding like Alex Jones now. Let me calm down. But they are positioning USDC as the chosen stable coin. You only need one. You really, there's really no marginal benefit to use one over another. So I think the powers at B, have picked USDC to be the one that's going to be like the CBDC. Okay, I don't think the government is really going to create their own CBDC. I think they're going to use USDC as proxy to get things done and freeze assets and monitor the chain and all that. Robinhood has officially listed USDC as a trading currency on its platform, according to the company's Twitter. Wow. That's, gotta pay attention to these things, ladies and gents. Got to pay attention. Another one out of Watcher Guru. And this is a question that's been posed. Are Bitcoin and cryptos steering away from their identity? You guys know my answer to that. And it's interesting and surprising to see Brian Armstrong. He's been making statements kind of to the contrary. I thought he was a bought, paid actor within the crypto space. I didn't think he, would be making these bold statements the way he is, but lately he's been, he's got the lawsuit against the SEC that he's not doing the lawsuit. He's funding the lawsuit that's being put up against the SEC. He's making statements like this. I mean, I'm just like, damn, man, you're really impressing me. I didn't think you would be this way. I thought he was a paid, bought agent. Honestly, Armstrong was seen pointing out how the U.S. should stay ahead in the crypto game and went on to compare the same to semiconductors and 5G as far as how we lost that race, right? We know that who's the number one semiconductor in the world? Where are they located? Not in the U.S., not in the U.K., not in Mexico, not in Canada, in Taiwan. TSMC is the biggest by a long shot, the biggest semiconductor manufacturer in the game. So we lost that race. And if I recall correctly, who is the 5G big dog? I think they're out of China, right? Isn't it Huawei or whatever, however you pronounce that? So I think Huawei is the 5G top dog, top G, as Andrew Tate would say. They're the top G in the 5G sector, telecommunication sector. And then you got Taiwan Semiconductor Manufacturing Company, top dog in the semi-chip sector. Both not in the U.S. Okay, we got Tesla. I know. We got Amazon. We got Apple. We got some heavy hitters. Don't get it twisted. But it's we gotta pay attention. So your boy Brian Armstrong throwing out, he's throwing out some real hits towards the powers that be. I don't know, man. He keep talking like this. Guess what? He's gonna be like Jack Dorsey and be minimized. He's gonna be minimized, or either minimized or booted from Coinbase as CEO. He'll still have his billions because he'll still have his stake, but they may quiet that guy. They just might quiet him. So that's pretty much it, though, guys. Thank you for tuning in. An hour and 56 minutes, just in time. This is how we do those off the chain episodes. Lick a shot. Everybody that tuned in. Shout out to From a G's Perspective. From a G perspective, I should say. Go check his YouTube channel out. He's doing great content over there. He does content on CBTV as well. He said crypto is the diversion most will fail. They few years ahead of Intel already. Yes, they are. Yeah, sad what happened to Jack. Can an NFT gift card fall under securities, man? Anything. I can fall under securities if they want it to be. Oh, Crypto Blow, you're a security. Damn. Going to jail. Love the stream, man. Keep up the great work. Thank you, Hidden Profits, Crypto. And as I promised, guys, I do have a nice discount for the Bloodalytics system if you guys want to join those profits. Because look, we getting it in. Crypto, yo, I love you, baby. I love you, man. But I wasn't early on that short. Bloodalytics was not early. You see where we got in. Come on, man. Don't fight the Fed. Don't fight the Bloodalytics. I put blood, sweat, and tears into programming this the right way, man. We getting it in, bro. Come holla at me. Come holla at me. Again, thanks for tuning in. Hit those thumbs up. Smack those like booties. You know what time it is. That's another episode of Off the Chain. Episode, I think, 87. Didn't put it in the thumbnail. But that's it, ladies and gents. It's your boy Crypto Blood. I'm out of here. Holla!
These rappers is whack, they lyrics are corn. I'm getting this money, it never get born. I'm loading my strap, they calling law. Fuck around on your clap, for running your jaw. If it ain't about the dollars, then it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like the crypto crash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash.
Smoking on that crippy got me cliff high. Steam pot, heat rock, slingshot. Surfing through the city while them chips rise. Hot boy, do it big time. Element with my summer bay, we booed up. Cali hit the bay, we fly MIA, we pulled up. Sipping on this drink, bitch, I know the way. We juiced up, nigga violate till it's JFK like your roof. Coin daddy bout them chips, nigga rap. Face all in a box, nigga Snapchat. Fucking with the ops to get you clapped back. No cap, nigga rap.
Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Yeah. Yeah. Stacking my coin, stacking my coin. Stacking my coin, stacking my coin. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, Litecoin, Ethereum, cash. Bitcoin, stacking my coin, stacking my coin. Stacking my coin, stacking my coin.
Fuck it! Do it live! I'll write it and we'll do it live!
Okay. Ready?
Fucking thing sucks! We'll do it live.
Okay.